welcome back to Lamb's Cryptoverse. So today, I'm not going to show you my lovely face. So some of you might be happy about that, who knows. And another thing I want to talk to you about is I'm going to do something different. I'm going to focus on Charlie Bilello's blog and go over most of his charts and in case you want to see my opinion, or just want me to read them to you, I can do that too. And then I've got some charts of my own. So let's go over this quickly because some of these charts are really interesting. Some of them are like, did this, done that, very familiar with it. So the first one, you might be like, I know this one. It says that and this is going back to 2022, it's a review. And he's saying that the first day of trading in 2022 was very much like 2021. And here in this table, he's showing in blue the number of all-time highs. So nothing spectacular. And as you know, in 2023, this year, it did not start off with a bang. Actually, it did, but then it slowed down, and then it went up again more recently. It's been zigzagging, but definitely, it's definitely continuing the Santa Claus / January effect rally that began in, Christmas time. And then here is showing you the market cap. Apple kept hitting new market cap highs, and obviously that's no longer the case. 2023. Now this chart's interesting, this table. He shows with Christmas colors and green and red, the disparity between 2021 in 2022 in terms of macroeconomics. For example, the first one, we had free money. Actually, it's 2020 and 2021. We had a liquidity injection. In 2022, the effect is wearing off. I would actually call it a hangover. The next one he's saying is easy Fed. Okay, I thought he meant that for the first one. Maybe for the first one, he's talking more about the 2020 stimulus, which went into 2021. So again, the second one's a repeat of the first one, basically. The third one, a smooth ride higher, and now we've got more volatility. We know that. But actually, the volatility at the beginning of 2023 is actually the lowest it's been in a year. But we're in a new regime, so lowest in a year really means a volatility of the VIX between 18 and 20. Now, if you look at the previous regime, before the COVID crisis, the volatility index went as low as 10. So just keep that in mind. We're in a new regime. Earnings boom, record margins in 2021, and tougher comps, margin compression. I think this is more of a story for 2023 for this year. It hasn't even started yet, so I'm not sure I would have put this in. I think the margin compression and lower earnings are going to start maybe right now, maybe by the first quarter of 2023. And then 2020 and 2021, don't worry about inflation. And 2022, stagflation is a risk. Yeah, I'm disagreeing with everyone calling it stagflation and almost like a Goldilocks economy in 2022 and actually especially 2023. I think we actually may get a hard landing because the Fed keeps raising rates, and then I think they're going to hold them. So it's going to be tough. That's not conducive for like a slow economy. It's more like a declining economy, a recession. 2021, record housing appreciation. 2022, housing slowdown. I'm going to talk to you about that later. And 2020 and 21, we had a mania. We also saw that with the Robinhood and the meme stocks. And they actually topped off, believe it or not, not in December 21 when the market topped. They actually topped off in February of 2021. Yep, that's when the meme stocks topped out. And then he mentions here weighing machine. That's what Warren Buffett says, that in the long term, the stock market is a weighing machine. Basically, it weighs the value of individual companies. Okay, number 2, end of easy money. here he's just talking about here. He's just talking about how it's like rate cut after rate cut after rate cut under all these chairmen, especially Powell, and not especially, but with the exception being Powell. Now, where is Janet Yellen? Isn't that surprising? She's not here. That's kind of weird. Okay, the most universal tax of all. So he's just saying that the CPI is a tax, especially when you look at real wages, which I think he talks about going forward somewhere. Maybe we can get to that. Oh, here we go, right here. Real, I should say, U.S. Hourly earnings or year-over-year change, they're declining. They're negative because of inflation, obviously, but that's a short-term thing. So I wouldn't worry about that. That's a short-term thing. It's not going to last a long time. The Fed's definitely going to nip inflation. And this just goes over the Federal Reserve's total assets. We all know what happened in 2020 and 21. The Fed boosted its balance sheet. And as you can see, as of 2022, it went down only 2%. So that's going to be an issue for the Fed. I don't think the Fed is going to reach its goal of bringing down the balance sheet to about $4 to $5 billion. It's going to be almost impossible. So it's going to be like a staircase. We're just going to get a larger and larger balance sheet at the Fed, which means currency debasement. Even if we don't have inflation, it means a currency debasement. So keep that in mind. And this just shows effective, basically the Fed funds rate. And so you could see they started raising rates slowly. Remember what Jay Powell said. He said when there's inflation back in 21, he said, we're not even thinking of raising rates. So that's why he's got into this bad situation right now, number one. And number two, that's why he only raised rates 25 basis points in March. But then you could see he started front-loading the raise of rates. This is like a quicker raising of rates than is typical. And for the next meeting, I'm expecting a 25 basis point hike and the Fed funds rate, which would bring us back full circle to the March 25 basis point hike. So that would be exactly a year later and exactly 25 basis points. U.S. national debt, I don't need to talk to you about that one. We know where that direction is. We know where that's going. But the problem is the interest expense. It's doubled over the last few years. You could see it was around $400 million, and now it's heading towards $1 trillion. And that's insane because think about, what did I say? This is billions. I said 400 million, actually 400 billion. So we're talking about such large numbers. It's hard to conceptualize, but think about all the programs that that the government is not spending on because of this high interest expense. And so unfortunately, I think it's in the best interest of the U.S. government to keep inflation high in order to debase the currency so that the interest expense would be less painful for the U.S. government. Pretty sad, no? And this we already talked about. The Fed funds rate change. It's basically 4.3%. So it's going up at a pretty fast rate. The last time it went up that fast, I know this is kind of hard to read. Maybe I should go over it again. So this is showing the change in the Fed funds rate. And so for last year, it went up 4.3%, basically from zero. And that's the most it's gone up since 1980. And we know what happened in 1980, right? The inflation. And the bond market's been going down like crazy recently. But what he's focusing on in this chart is that there's been a very long-term trend towards lower rates. As you can see, from 1980 to 2021, rates went down quickly, but then they jumped last year. And this is basically another way of showing the yield curve. So you could see the rates that jumped the most are the short-term rates. the 1 month, 3 month, 6 month, and up to the 2 years. And you can see why. It's because the Fed funds rate is a short-term rate. So obviously the shorter term rate, market rates I should say, are going to be a mirror image. Well, maybe I shouldn't say mirror image, but they're going to follow the Fed funds rate. One key point that you should know is that the 2-year rate, cap market rate, tends to follow the Fed funds rate. Now, when it doesn't, and when the 2-year rate is below the Fed's funds rate, and that's we're starting to see that now, that's when it means the Fed rate cycle, increase in rate cycle, is coming to an end. Again, just to be clear, when the 2-year rate is below the Fed funds rate, that means the U.S. government, the Federal Reserve, is nearing the end of its cycle. And right now, we're seeing that. We're seeing the beginning of that, where the 2-year rate indeed is lower than the Fed funds rate. What do we got here? Oh, now just don't get this mixed up, because everyone talks about bond market declining a lot, but this is a U.S. aggregate, so this includes everything. And so you could see we had a 13% loss in 2022, and that's the most going back to 77. Now, this is the one most people are familiar with. This is a 10-year Treasury bond, so this tends to be the benchmark. And this is the most decline we've ever had. And you can see the 2-year decline is huge. You got 18 and 4. That's about a 23% decline from 2020, just enormous. And if you look at the table, one interesting point is every time we have a decline, we jump the next year. And now look at this. We had 2 consecutive years of decline. So I think the probability of the rates, not rates, bonds, of Treasury bonds rising dramatically in the next year or 2 is high, just looking at this table. But knowing what I know and what we know, that the Fed's going to pivot soon and that the economy may be in a recession, it just makes the case stronger that Treasury bond prices are going to rise sharply during 2023. Maybe not now, but probably in the second half of 2023. And this just looks at various durations. Obviously, the longer duration, like the 25 plus year zero coupon bond, went down the most. So this is stuff that pretty self-explanatory. I cannot bring anything value to this, except maybe that I think you should be down here in the longer term treasuries because of the shift in the yield curve. Otherwise, I can't bring anything of value here, because this is just looking at different sectors of the market. So let's go to the next chart. And this is just S&P total returns. Just one thing I want to specify, it's really important that he didn't talk about this week, but he's spoken about it before, and he wrote about it. Basically, Charlie Bilello has said that the S&P total return tends to be much larger when we're in a recession. And so I think that's going to be the case. So what I'm trying to say is here, I hate to say that even though this 18% decline in 22 was large, one of the largest in a while, I think we're going to have another decline in 2023, at least the first half. I think we're going to have a big drawdown because it looks like we're having a recession. So that's my base case framework. So maybe we'll go down 18% in 22 like we have, and then another 10 or 20% in 2023. Of course, that may be, or maybe even flat, but what we may see is a very sharp decline in the first half of 2023, and then a rebound in 2023 as the Fed pivots later on if the economy goes into recession. Remember, this is not financial advice. I'm just guessing and using probabilities and all the information that I gather up over the days. And here he's just talking about EPS growth. I think we're going to have he didn't talk about it yet here. He's just talking about 2022. But I think there's going to be a big decline. And this data, unfortunately, doesn't go back much. I wish it would have gone back to the last few recessions, because I think we're going to go down steeply. And I'm not going to count 2020 because that's where the government basically shut down the economy. We're not going to get that, but we're going to definitely get lower earnings. And that's going to bring down the stock market. What else? Well, actually, this is interesting. I mentioned I thought I mentioned that he didn't talk about how the market does during recessions, but this actually talks about it because if you see, he labels the rows that have officially been in recession, those time periods. So you could see, I'm not going to go over every one, but you could see when there's a recession, the stock market tends to go down more. That's the most important thing for you to know. You can always stop this video and like just take a look at this stuff and stare at it. Or you can just go to his website. It's basically Bilello.blog. Again, it's Bilello.blog, and that's a double L. The second L is a double L. Um, I'm going to skip some of this and go to some important stuff. Uh, we already know that these are down years. He's basically showing and saying that it's one of the few times in history where both the bond market and the stock market went down. Actually, one really important point, which he doesn't say here, is that pension funds, especially old-fashioned type pension funds that are run, like we see here, the 60/40, they're getting hit big time. So he didn't mention that. I think that's the most important point here, is that some city and state pension fund and education funds and endowments are going to get hit depending on how the portfolio is structured. But a lot of the more cutting edge endowments and pension funds also have real estate and private equity and private debt. So let's go to the next chart. So this just repeats basically what we said before, that the S&P and the bond market were correlated last year. That's why the correlation is so high. But normally they're not. And then housing market is down. I think everybody knows this, so we're going to go over that. We're going to breeze over this quickly. We know that the 30-year rate more than doubled from the bottom. And you can see right here, that's a 30-year rate, 30-year U.S. mortgage rate. And this is pretty scary. The median housing payment as a percent of how much you're making has gone through the roof. So that just shows you how unaffordable homes are. And because they're unaffordable and because rates are high, you could see existing home sales are the lowest since November 2010. That's pretty sad state of affairs. But what's strange is the median sales price hasn't gone down. It just shows you, if you think about how tight the inventory of homes are. Because really, the sales price of homes, basically average prices should be going down quickly right now. They're not because of inventories. And if you want to do well in the market, real estate market, it appears you need to be in Florida or Georgia or someplace close to Florida. It's pretty amazing, right? Miami, Tampa, Florida, Charlotte, Atlanta, Georgia, Dallas, Texas. A lot of the more southern areas. And then on the West Coast here, they're getting killed, right? Portland, Seattle. Look at San Francisco. Whoa. And if you look on the right side here, you can see percent below the all-time high. You can see San Francisco got hit the worst. He just talks about meme stocks here and how ARK Innovation has gone down. This just shows that even Tesla can decline rapidly. And I think Tesla is closer now to its bottom than it was before. You got to look at it, different types of valuation multiples, like EV to revenues, EV to EBITDA, things like that. Price to earnings ratio, the price to earnings ratio compared to growth. If you look at all those ratios, Tesla definitely looks like it's starting to become a value stock, believe it or not. And this talks about meme stocks have been like cratered. They've just crashed. Look at that. Wow. They're like 90% from the high. It's like crypto, isn't it? Speaking of the devil, crypto's gone down like crazy, 65.5%. But as you know, in 2023, it's been doing really well, and all coins are doing really well. These are the crypto returns, and that's about it. This is just showing Russia is declining. I think we all know that. And what's this other one here? This is the returns by country, and you can see Russia's in last place. Um, and this is a recession debate. They're asking if the first quarter and the second quarter were really recession. I would say no, because the labor market has been so damn tight. So I would definitely say no for that. I think we're done. I want to show. Oh no, we're going to talk about payrolls, and I want to show you some of the charts I gathered. Here we have total U.S. non-farm payrolls are still going up. The job market's really tight. Wage inflation is alarming for the Fed. And unemployment rate is way too low. It needs to double. So that's why the Fed's keeping rates high. And as I mentioned earlier, I think we're going towards a recession, and even the old reliable LEI, leading economic indicators, are showing that we're headed towards recession. And this is the one thing I want to mention here. He talks about the 10-year, 3-month Treasury spread. Usually it's a 10-2, basically. So the 2-year rate versus the 10-year rate. So it's a little strange they use that. And I tend to use this one and the other one combined, just to make sure that I'm reading the data right. But they're basically saying the same thing. They're basically predicting a recession because we're inverted in terms of the yield curve. But if you could see, one thing I didn't know, which is really interesting, the lead time is huge. It's like 24 months on average from when the yield curve first inverts. And this is showing how commodities were king in 2022. You can see where my pointer is. They went up 19.3%. And that's mostly because of energy. I think that's about it. I'm not going to talk about too much of the stock market. I already mentioned that energy was strong. And this is listed some of those companies. And the sentiment index is going down. What's he saying here? They're saying there's more bears, but now, as of January 22nd, we're starting to get more of an even balance. And actually, Investors Intelligence has actually shown more bulls than bears, so this is not holding up for this year. I think that's about it. Yep, that's about it. I also want to show you these two charts. Let me go into preview. This is really amazing. This is a financial conditions index. And if you look at it, you could see that, and maybe I should make it smaller. Whoa, too small now. So now you can see the title. Basically, it's shown something that I am shocked about. That financial conditions actually rose from the bottom in September all the way up to where they are now, where they're actually above zero. So financial conditions have loosened dramatically. So liquidity is actually loosening. And that's really shocking to hear from. This is calculated by Bloomberg. So you can see this is the highest since March. That's a scary scenario to see. Other one I want to show you is that, as I mentioned before, I don't think, let me just fix this so you can see this. Okay. This is the Fed funds rate in black. The market pricing of the terminal rate, meaning, what's the last Fed funds rate going to be for this rate cycle. And then the blue one is a dot plot, basically, the median dot plot. So what's really interesting about this is that the market pricing, and that's in red, is below the Fed's median dot plot. Maybe this is not as good. I've seen other ones that are better. I've seen ones that show the 3-month forward rate in the future. And basically, if you look at that forward curve, it shows you more dramatically that investors in the market are expecting the Fed to pivot, even though the Fed says they're not going to pivot. And that their dot plot indicates they're not going to pivot, but it appears that the market believes they're going to pivot. So that's everything from Lamb's Cryptoverse. I hope you enjoyed this, and thanks for listening. Bye-bye.